I would like to welcome everyone to this course today. My name is Dr. Konstantinos Serdaris. I'm originally from Greece, but I'm lecturing law at the University of Southampton in the United Kingdom, in England. And today we were talking about the new EU regulatory framework for financial return crowdfunding and how it can help tackle the financial constraints of SMEs. Let me give you a bit of a background before starting my lecture. So as you already know, the overarching theme of this year's International Week is on post-pandemic recovery and the resilience, covering topics related to regaining the momentum of growth and prosperity for businesses, with particular focus on digitalization and modern technologies. So in this framework, today's lecture touches upon a very topical issue, namely the use of alternative funding tools in tackling the financial constraints of small and medium-sized enterprises. More specifically, we will be focusing on financial return crowdfunding and the importance of an effective regulatory framework in supporting the development of this new funding tool. Now, our case study, as I already mentioned before, will be the new European regulation on crowdfunding service providers. And the reasons behind the choice to discuss the EU regulatory framework are mainly three. First of all, as you already know, I suppose, the European Union is one of the largest economies in the world, and the regulation implemented there has a great impact on several other jurisdictions around the world. Now, the second reason is that the EU crowdfunding regulation was put in place very recently, and it contains several provisions which are quite innovative from a legal economic perspective. And finally, regulation in the EU is a complex political process in which multiple actors interact across different levels of governance. So I thought this would be a good opportunity for you to gain an understanding of some of the regulatory functions at the EU level. So having said that, in this course, we will start by providing an overview of the financial constraints faced by small and medium-sized enterprises worldwide. Then we will refer to the emergence of crowdfunding, the reasons why it emerged, by providing a concept, an explanation of its concept and characteristics. Then I will refer to the main crowdfunding business models. After that, I will provide you with an overview of the main benefits and drawbacks of financial return crowdfunding, the rationale for regulatory intervention, before we delve into the main part of this analysis, which is going to be the new regulatory framework of crowdfunding, where first I will give you an overview of the objectives and challenges faced by regulators, then an overview of the main provisions in order to achieve these objectives, and finally, we will conclude with an evaluation of the crowdfunding regulation. Now, before starting this presentation, I would like to give you some remarks, which I would like you to have in mind when listening to this lecture and participating, actually. I'm aware that most of you here have not studied law before. At least this is what I was told. So even though this is a lecture on regulation, I have tried to make it more accessible as possible by avoiding, whenever this is possible, legal terminology and details which are incomprehensible to the uninitiated. Moreover, while I have tried to avoid technical jargon, at several points of this presentation, I will be using some technical terms which are relevant to crowdfunding. In most of these cases, I will provide the relevant definition, but if there is anything you do not understand, please do not hesitate to ask for clarifications, either by raising your hand or writing in the chat. So wherever you want to intervene or whenever you do not understand something, just raise your hands if you're in the room or in the chat via Zoom. And I would be very happy to provide any kind of clarification. So finally, I know that participation in lectures is usually passive, and this is even more the case in an online context, because we do not have this in-person interaction, and I cannot really see everyone participating in the Zoom meeting. However, I would really like to have some interaction during this course, and therefore, whenever you want to intervene, do not hesitate to interrupt me. And I will also try to initiate some kind of discussion by asking you some questions once in a while. Let's see if this works. If not, then it will have to be one part of the presentation from my side, and then in the end of the lecture, we're going to have 15 minutes, more or less, for a Q&A session. Now, is everything clear until now? Yes, it is. So let's start with the main part of the presentation, the financing constraints of SMEs. Now, you should bear in mind already from this very beginning that in order to develop their business and grow, companies, all kinds of companies, require capital, which can be raised either through internal or external financing sources. Now, what do we mean by internal or external? In the case of internal financing, funds are generated by the business itself, mainly through the contributions of existing participants or through reinvesting the company's retained profits. External financing, on the other hand, is obtained from outside the firm and takes various forms, such as loans from banks, investments from business angels or venture capitalists, or even proceeds from the issuance of financial instruments, that is, instruments which are offered to public investors through a public offer or the stock exchange. Now, while the exact funding requirements of a firm vary depending on its level of development, sector of participation, and growth objectives, so every kind of firm has its own financing need, depending on where it is active, what their objectives are. The need for external financing features quite prominently during the life cycle of every business, and this is either for basic maintenance or for further development and expansion. However, many companies, and especially small and medium-sized enterprises, which we're going to refer from now on as SMEs, so these SMEs often find it challenging to secure access to external sources of capital to finance their activities. Consequently, several promising new enterprises often fail to get off the ground, with negative effects for economic growth, innovation, and job creation. So I would like to ask, can you imagine any reasons why small and medium-sized enterprises face financial constraints? Why is it so difficult for them to raise financing? Do you have any idea? Well, there are actually many reasons for that. So, first of all, the business prospects of these companies are many times uncertain. They are in general considered riskier than larger companies because they demonstrate higher sectoral and geographical specialization. And by that, we mean that they're focused in a particular sector or they are active in a particular area. Moreover, they're not often in a possession of collateral, so they cannot secure with collateral the money that they raise from a bank, for example. Consequently, they face several credit constraints, especially in periods of economic contraction, where banks do not provide capital so easily. And at the same time, lending costs are significantly higher for them. So this means that they would have to pay for a higher interest when they borrow from a bank. Now, another reason is that unlike large corporations, it is very challenging for most SMEs to raise capital on public equity and debt markets. In other words, it's very difficult for these companies to raise capital through, for example, a stock exchange. And this is both due to the costs of going public, which often outweigh, as we will see, the relevant benefits, but also due to the overall uncertainty associated with investments in such companies. So these companies do not usually have a long track record, and therefore investors are quite hesitant to participate in them. Finally, another reason is that traditional providers of risk capital, and here I mainly refer to venture capital firms. So these are mainly funds which participate in early stage companies by providing capital. So these firms often lack the required scale and geographical reach to support all eligible undertakings, so they cannot provide capital to every promising company. Or they often make the provision of funding subject to strict control rights, which small and medium-sized enterprises are often reluctant to give. So in order to participate in an SME, these venture capitalists usually ask for a high level of control. And since SMEs are usually administered by families or very few people, they're quite hesitant to give out control to a third party. And therefore, many promising SMEs are left without financing. Is everything clear by now? Now, against this background, so against these constraints that SMEs face in financing, during the last years, an alternative funding tool has become available for startups and other SMEs, which is known as crowdfunding. So have you ever heard of this word before? Do you have any idea what crowdfunding is? For example, in which context have you heard about crowdfunding? I see Kickstarter in the chat. This is correct. This is one of the most famous platforms. Do you know what kind of projects seek financing through Kickstarter? A way of raising money for businesses. This is correct. So how does crowdfunding usually work? So before explaining the classic model of crowdfunding, and even though it is very difficult to give an exact definition of this tool, given that it is a very quickly evolving phenomenon, we could say that it can be described as an open call to the public to raise funds for a specific project through the intermediation of an internet platform. So, in the classic crowdfunding models, a fund-seeking entity, so either a person or a company, will send an application to an online platform to promote their project on its website. So they have a project which they want to fund, therefore they will send an application for funding to the crowdfunding platform, to the online platform, like Kickstarter, for example. Now, after the project is accepted, the promoters of the project, so the persons who look for funding, are asked to prepare what we call an online pitch. And this is usually in the form of a short video. So the pitch actually tries to explain the main idea that for which funding is sought and provides the most important information about the project. Now, this is usually accompanied by a standardized contract, which features comprehensive information about the funding procedure, including at least the funding goal, that is the amount for which funding is sought, a time limit for achieving this, as well as the way that the amount raised will be used. Now, funders will typically provide money to the campaign directly through the crowdfunding platform. And if the funding goal is reached within the allocated time frame, then the project owner receives the money pledged. If not, so if this funding goal is not reached, then in most cases, investors will be reimbursed for the money they gave. So this is very briefly how crowdfunding operates. Now, from these general concepts, we can extract the following characteristics of crowdfunding. The first one is related to the use of the internet. Now, before continuing, I have a question in the chat. So, websites like GoFundMe are considered crowdfunding or not? Yes, they are crowdfunding platforms. So they are the intermediaries, as we will explain. And with regard to non-profit, to the raising of money for non-profit projects, I will explain the differences between the various business models in crowdfunding. So let's have a very brief look at the main characteristics. As you might have understood already, while the idea behind crowdfunding is not novel, so the idea of raising capital from many different people dates back to many, many years, what makes this funding tool new is the use of internet technologies. So the internet makes it possible for the promoters of a project to contact a mass of potential backers from around the world at a low cost, something that would be impossible in an offline context. So what actually crowdfunding offers is that me, who I'm currently in the UK and I seek funding for my project, can have access to theoretically indefinite number of potential backers around the world. So someone from Indonesia, for example, could provide funding for my project. So outside the crowdfunding framework, so in an offline context, this would be perhaps impossible. Now, another characteristic of crowdfunding is that it is a tripartite business. And this is because it involves at least three types of actors. First of all, we have a project owners. That is a person or a company seeking finance for a business or idea. So this is the first party. On the other side of the transaction, we have the funders, who are mainly individuals, but also legal entities, who contribute to the project with a certain, usually small sum of money. And in the middle of that transaction, we have crowdfunding platforms, which are legal entities that operate a website which facilitates the matching between project owners and funders. So three main parties in the transaction. First, the project owner. Second, the funders. And in the middle of this transaction, we have the crowdfunding platform. And this is very important to remember throughout this class, this lecture. And finally, crowdfunding can take various forms, each of which matches the general concept described above, but demonstrate different features which in turn have diverse implications from a regulatory standpoint. So let's have a closer look at the main business models under which crowdfunding operates. And by that, I'm also going to answer to the question raised before. Now, a standard and generally accepted classification of the crowdfunding phenomenon distinguishes between four main business models. The first one is called donation-based crowdfunding. Then we have reward-based crowdfunding, and then lending-based and investment-based crowdfunding. So these are the four typical models, business models of crowdfunding. Now, these models can in turn be grouped into two general categories. On the one hand, we have what we call non-financial return crowdfunding. This is where funders do not anticipate any kind of compensation in exchange of their contribution and includes the donation and reward models. And on the other side, we have financial return crowdfunding, where crowdfunders provide capital in return for a financial reward. And in this model, we can find lending and investment crowdfunding. Now, this distinction is very important because financial return models are much more relevant for business financing. And at the same time, they raise serious legal issues which are associated with the nature of the underlying transactions between the funders and the project owners. So for these two reasons, in this presentation, I will focus on financial return crowdfunding. So we're going to discuss the regulatory framework about lending and investment-based crowdfunding. However, before going into details, let's have a closer look at what each crowdfunding business model is about. Now, you mentioned before Kickstarter and the fact that it's mainly used for donation. So this gives us a hint about what donation-based crowdfunding is. So in this model, the funders, so the crowd, donate small amounts to meet the larger funding goal of a specific non-profit or charitable project without receiving any kind of compensation or material return. So in this model, a charity will ask for a donation for small amounts of money in order to fund a project or an idea. And crowdfunders only provide the money without anticipating any kind of financial return. This is one of the first types of crowdfunding, and its success contributed to the overall development and popularity of this new funding mechanism. So crowdfunding initially started as a means for providing donations for charitable and non-profit projects. Now, next to donation-based crowdfunding, we have the reward-based crowdfunding. So in this model, individuals contribute to a project or business with an expectation of receiving in return a non-financial reward. And this can be in the form of a good or service at a later stage as a recognition of their contribution. So These can be usually found in artistic or cultural activities. For example, it has been the case for many movies or songs for artists to seek funding through crowdfunding in order to fund their activity. And in return, they provide, for example, a reward in the form of a T-shirt, for example, with a thank you. If it is in some movies, for example, or the participants, the crowdfunders are included at the end of the movie. Or it can also be a copy of a record in case that crowdfunding is used, for example, to fund the recording of a new record. Now, as it is the case with donation model, this does not represent a very big part of the total market volume, but it is very important for many people, especially, as we said before, artists and in general, cultural activities. Now, what we're going to discuss in this course is financial return crowdfunding. So as we said, this includes lending-based and investment-based crowdfunding. So in the lending model, individuals and businesses obtain funds from the public in the form of loan agreements. So this means that lenders will make available to the fund seeker a fixed amount of money for an agreed period of time in return for the unconditional repayment of that amount, usually together with some interest, according to an installment payment schedule. So this actually resembles a loan, a typical loan that you might receive, for example, by a bank. But instead of having one lender, we have many different lenders. We have the crowd that provides small amounts of money to the project owner. So this has the form of a loan agreement. Now, next to lending-based crowdfunding, we have investment-based crowdfunding, which is also known as crowd investing. So under this model, a company can raise finance from numerous investors in return for equity or debt securities, but also other financial instruments which allow their holders to participate to the future profits of the firm. So in this case, we have a fund-seeking company which issues some kind of equity or debt securities like stocks or bonds. And in return, funders provide small amounts and they're given these securities, which often provide the right to participate in the future profits of the firm, especially when it comes to equity securities. Now, the significance of this last type is quite increased. It has increased during the years, but it is far less popular than its lending counterpart. So lending-based crowdfunding is the most popular form of crowdfunding around the globe. Are there any questions until now? Is there anything that you would like me to clarify regarding the main crowdfunding business models?
Sorry, sir.
Yes?
Maybe I will ask regarding the crowdfunding in terms of the business, in terms of the law, sir. For example, like the Kickstarter is mostly, I think, use a reward-based crowdfunding, I think. But most of the time, Kickstarter is start from the home country of the company that need that crowdfunding. For example, a company A is based on the United States of America, like that. I know that Kickstarter has, for example, privacy, if some compulsory agreement with the crowdfunding if something happen like that. If for some reason I crowdfund from Kickstarter and that country is from another country, from example is based on the US and I'm from Indonesia, and that company is not have, I'm sorry, I forgot the English, not give my reward based crowdfunding, can I, like, for example, have a legal matter in that, sir? I think that's my question. Thank you.
Okay, so if I got it correct, you're asking how are the capital providers actually protected uh, from, for example, not receiving the reward or the money that they have pledged. And I will come to this question um, very, very, very soon. I also have a question from Gillen. Yes?
Yeah. So I was just looking at your investment-based crowdfunding, and I was thinking, like, this kind of seems like just like a stock market, like a public stock market. Like you have a company raising finances from numerous investors in a public setting, and they also get equity, and they can get future profits, as well as they get equity or debt securities. And I was wondering what the differences were between like an investment-based crowdfunding and just like the public stock market. Thank you.
Great. There are some similarities between investment-based crowdfunding and capital raising through the stock market. However, we should make a distinction here. Not every public offer of securities, so not every activity of raising funds through the public takes place through the stock market. So the stock market is what we call a regulated market. It is a secondary market where already existing securities can be marketed between different investors. So the initial capital raising activity takes place elsewhere. It takes place through a public offer of securities, as we call it. So these are two different things. First, we have the public offer, which can take place either through traditional means or now through crowdfunding. And then we have the introduction, as we call it, to the stock exchange, the admission to the stock exchange. And this is a means for increasing the liquidity of the investments which have been offered. So these are two different things. And it is good to remember that not every public offer of securities involves the admission of the securities to a stock exchange. Is it clear what I'm trying to say here?
Yes, thank you so much.
Great. Now, let's see why financial return crowdfunding is so important. So what are the main benefits, in addition, of course, to providing an alternative source of financing? So first of all, it can help reduce the cost of capital raising, since, as already mentioned, contrary to traditional offline mechanisms for financing or early stage ventures, it provides access to a global rather than local pool of potential funders. Moreover, it can give a proof of concept and idea validation. It can also help attract other sources of funding, such as private equity funds and business angels. So crowdfunding is the first stage of financing, what we call seed funding. And then if it is successful, it might give access to other sources of financing. Moreover, as we already said before, it allows more control to the project owner compared to when they seek financing through banks or venture capitalists. It can also give access to a large number of people who provide the promoter with useful insights and information. So crowdfunding also gives access to a community of funders who can also provide insights to the project owner about the project. And finally, it can also serve as a marketing tool if the campaign is successful. So if the promoter manages to raise funds through crowdfunding, this might act as a signal for potential future investors who will be more keen in participating in this project. Now, there are also some drawbacks. So apart from the obvious benefits for project owners, financial return crowdfunding also carries significant risks for investors. This includes mainly the possibility of losing part or all of the capital invested, or not getting the returns expected. So there is a risk of losing the money which have been put into crowdfunding. Now there's a big, there is an ability to properly assess the true value and prospects of the business or project for which funding is sought. This is due to information asymmetry and the lack of specialized knowledge from the side of funders. There are also very high agency costs due to the dispersed nature of the crowd and the limited availability of controlling mechanisms. This means that exactly because crowdfunders are dispersed around the globe, it is very difficult for them to control the management of the crowdfunding company, and this raises agency problems. There is also the potential for conflicts of interest, especially where the platform is remunerated by or has some participation in the project. There are also high operational risks and probability of failure of the platform, and also the risk of discontinuity in the services offered that this would entail. There is also very limited possibility of liquidating the investments due to the lack of a secondary market. So crowdfunding investments are rarely entered into a regulated market, admitted into a regulated market like a stock exchange, and therefore it is very difficult for investors to liquidate their investments. And finally, there is also a risk of misuse of personal data and the potential use of platforms for the funding of illicit activities. So I see in the chart the potential problem of money laundering and what governments do. This gives me a great pass to go on to the next slide, which actually deals with why we need regulatory intervention. So we have many benefits from crowdfunding. At the same time, however, we have drawbacks, and the use of crowdfunding for financing terrorism, for example, or general illicit activities is there. So why do we need regulation? Now, the activities which are usually performed by crowdfunding platforms typically involve the provision of services which would require market actors to abide by existing general regulatory requirements. So platform operators would, for example, need to comply with certain authorization, organizational, and conduct of business obligations, while project owners must normally provide some disclosure duties. So in general, the kind of activities that take place through crowdfunding give rise to some general regulatory obligation. But despite such generally applicable rules, the failure to appropriate specific measures may have several adverse consequences for both project owners and funders. For example, it may hamper the facilitation of platforms' activities where the standards set by existing rules are not suitable for the circumstances in which crowdfunding platforms operate. At the same time, it may result in unnecessary burdens for project owners or even lead to gaps which may be exploited at the expense of funders' interests. And consequently, this may set off a helpful source of finance for SMEs and a potentially attractive outlet for capital deployment by investors and lenders. So you can see that there are some specific issues which are related to crowdfunding and which call for very specific measures and which are tailored to crowdfunding in particular. So against this background, many jurisdictions around the world have introduced bespoke regulatory frameworks for the financial return crowdfunding, which are nevertheless quite consistent in their broad approach, since they focus on facilitating access of businesses to this source of funding, while at the same time addressing the key risks that may arise, especially for investors. Now, in the European Union, investment and lending-based crowdfunding are governed by the regulation on crowdfunding service providers for businesses, which is going to be referred from now on as ECSPR, which applies to all member states of the EU. The EU consists of 27 different member states as of November 2021. So 27 countries in Europe which participate in the European Union have to apply this particular regulation. Now, what are the objectives of the CSPR? First of all, it's important to know that this regulation is an integral part of the Capital Markets Union. And what is the Capital Markets Union? This is an European plan which was first introduced in 2015 to create deeper and more integrated capital markets in the European Union. So the aim of the Capital Markets Union is to help businesses tap into more diverse sources of capital from anywhere within Europe and make markets work more efficiently and offer investors and savers additional opportunities to put their money to work. And this will in turn enhance growth, create jobs, and increase financial stability. So in this framework, the overarching objective of the crowdfunding regulation is to create a well-functioning single market for crowdfunding services, which shall improve access to finance for European SMEs, especially startups and other fast-growing companies, while at the same time increasing the possibility for efficient portfolio diversification for investors, especially retail ones. Now, in order to achieve this overarching goal, the ECSPR builds on two more specific objectives. First, enabling platforms to expand across national borders by laying down less stringent requirements for the provision of crowdfunding services. So the first objective is to facilitate the cross-border expansion of platforms, while the second objective is to enhance the trust of investors to the crowdfunding market. And this is done by strengthening the integrity of the platforms, that is, by making sure that platforms operate in a clear and consistent manner, while at the same time improving transparency regarding the project owner, the instruments being intermediated, and the crowdfunding process. Now, what are the main challenges in achieving these objectives? Many of you have already mentioned some difficulties which might arise within the crowdfunding context and how difficult it might be for regulators to catch and counter all these challenges. So, especially within the crowdfunding, the European crowdfunding framework, but also generally in every regulatory framework with crowdfunding, there are two main challenges. The first one is associated with the regulation of crowdfunding platforms. More specifically, while enhancing investor confidence in the integrity and competence of platform operators is an essential condition for the smooth functioning and development of the market, operational and compliance requirements could, if not carefully designed, create undue barriers to the detriment of project owners and investors. So, in other words, as important as it is to ensure that platforms operate operate in a consistent and operationally good manner, we should not put too many burdens on them, because this could have an effect on their willingness to operate in the market. Therefore, it becomes apparent that an effective regulatory regime should appropriately address the risks posed by the intermediation activity of platforms, but at the same time, this would not burden them with disproportionate or unnecessary obligations. So the first challenge is how to strike a balance between the need to protect market participants from the potential risks posed by the platforms, while at the same time avoiding excessive or unnecessary regulatory obligations. Now, the second challenge is related to the issue of achieving a balance between improving access to crowdfunding for SMEs on the one hand, and on the other, ensuring that the interests of investors are adequately protected. And I mention that because while investors and lenders require adequate and sufficient information in order to decide whether to participate in the funding of a project, disclosure obligations also imply significant costs for fund seekers, especially when compared to the amounts raised. In this respect, particular attention should be given to safeguarding that any effort to support the efficient allocation of capital from investors through crowdfunding does not render access to this funding tool for project owners. So the second challenge is how to achieve a balance between improving access to crowdfunding for SMEs and ensuring that the interests of investors are adequately protected. So how does the regulation address these challenges? Now, if we were to break down the provisions of the regulation, we would conclude that it can be divided in three main categories. The first one consists of those provisions which aim to facilitating the raising of capital for businesses. And these are mainly related to the type and size of the offers that can take place through crowdfunding, as well as to the disclosure requirements that apply to project owners. The second category of provision focuses on the essential conditions which govern the provision of crowdfunding services, but also the principles which should guide the conduct of crowdfunding platforms in securing the interests of their clients and their confidence to the market. And these provisions are mainly related to the authorization of platform operators, as well as to the organizational and conduct of business requirements which they must fulfill when providing their services. Finally, the third category of provisions addresses the complex and demanding issue of investor protection. And it primarily consists of disclosure rules which seek to ensure a high level of transparency. And this is complemented by certain know your customer rules, which we will explain later what it means, which apply exclusively to non-sophisticated investors, because these types of investors suffer from certain cognitive limitations and biases, and are more likely to misjudge the risks associated with crowdfunding investments. So there are specific rules in place, specific provisions, which are catered and tailored for non-sophisticated investors. So some of the rules that we're going to discuss for protecting investors apply only for non-sophisticated ones. So let's start with the measures put in place to improve access to crowdfunding for businesses, and more specifically from the type and size of the crowdfunding offers which are covered by the regulation. Now, the regulation encompasses, as already said, both lending and investment-based crowdfunding, which, as we already explained, are the most relevant models for business financing. Now, as regards lending, based crowdfunding, the regulation applies to crowdfunding services that consist of the facilitation of granting of interest-bearing loans. So only interest-bearing loans can be offered under the regulation in the case of lending-based crowdfunding. Now, regarding investment-based crowdfunding, the principal consideration for EU regulators goes to restrict as much as possible the liquidity risks which are inherent in investing in unlisted firms. So the main consideration was to ensure that investors participating in crowdfunding would be able to liquidate, to dispose of their participation in a crowdfunding project. And therefore, the regulation covers and permits crowdfunding offers related to, first of all, transferable securities, given that they are freely negotiable and can be easily disposed on the capital markets, but also shares of private limited liability companies, provided that they are not subject to restrictions that affect their transferability. Now, as far as the size of crowdfunding offers is concerned, the threshold is set at 5 million euro per project owner. And this will be calculated over a 12-month period as the sum total of the value of the financial instruments offered and loans granted through crowdfunding platforms. So the amount that the project owner can raise through crowdfunding over a 12-month period, that is throughout the year, cannot exceed 5 million euro, which is, I think, $5.3 million. Is everything clear until now? Would you like me to provide any kind of clarification? So if not, let's see the second set of provisions for improving access to crowdfunding for businesses. Now, we mentioned before how capital can be raised on public markets. We also had a very brief discussion about stock exchanges. So this brings us to what we call the public capital market. So outside the context of crowdfunding, the offer of financial instruments to the public would normally rise to the obligation to publish a prospectus. And what is a prospectus? This is a formal document which contains detailed and extensive information about the issuer and the securities offered, and is very costly to produce because it requires the participation of many professionals with high degree of expertise, like lawyers, investment bankers, etc. So usually a prospectus may count for like 500 pages, densely written with very detailed technical information. So you imagine how difficult, how costly it would be for a small business to issue these kind of documents. So by way of derogation from this rule, and in an effort to reduce the costs of funding for businesses, the regulation explicitly exempts crowdfunding offers from prospectus requirements. So in the place of the expensive prospectus, the regulation provides for a much shorter investment document, which is called Key Investment Information Sheet, or KISS, which can be easily drawn up by the project owner. It is not verified or approved by a supervisory authority, and contains only some basic information about the project owner and the crowdfunding project, the purpose, main features, and risks of the investment, as well as the respective costs and charges. So these are mainly the provisions which aim at facilitating access to crowdfunding for businesses. But what about crowdfunding platforms? These are the main, say, players in the market. they are in the intersection between investors and project owners. And therefore, they have to be regulated because, as you correctly mentioned before, and as we explained, their intermediation poses different risks. So, first of all, as you can imagine, in order for an entity, a legal entity, to be able to provide crowdfunding services, it needs some kind of authorization. So, who can gain authorization under the EU crowdfunding regulation? So, this authorization is reserved only for legal entities which are established in a member state of the Union. So, they need to be established in the European Union and have received authorization by the relevant competent authority of the member states where they're established. Now, very briefly, this authorization procedure starts with the submission of an application which shall contain all the information which is necessary to enable the competent authority to assess compliance with the requirements set in the regulation. Now, this competent authority shall, at the latest, within 3 months from the date of receipt of the complete application, conclude its assessment and adopt a fully written decision on whether to grant the requested authorization or not. Now, once the authorization has been granted, it is very important to know that the crowdfunding platform will benefit from what we call a single passport. This is actually what allows crowdfunding platforms to provide their services in any of the member states of the European Union without further constraints or formalities. So once the crowdfunding platform has been authorized under the regulation to provide crowdfunding services in one member state, then according to EU rules, it can provide the same services in every other member state in the EU. Now, apart from authorization requirements, we also have some organizational and operational requirements. And these are mainly used to mitigate the operational and business risks which are posed by the intermediation of crowdfunding platforms. At the same time, though, these requirements are tailored to the size, nature, and complexity of their business in an effort to strike the balance between what we mentioned before, the need to ensure adequate trust in the crowdfunding market without, however, overburdening platform operators. Now, more specifically, the natural persons which are responsible for the management and operation of the crowdfunding platform must be of good repute and possess sufficient knowledge, skills, and experience in order to carry the duties assigned to them by regulation. Moreover, they must develop a business continuity plan, setting up specific measures which, in the case of platform failure, can ensure the uninterrupted provision of critical services. So a continuity plan which can ensure that no matter what happens, platforms will be able to administer the offers and repay the investors. This answers one of the questions raised before. So what happens, for example, in case of platform failure? So these continued plans aim to ensure that platforms the smooth of administration of outstanding agreements and transactions. And finally, platform managers must put in place prudential capital requirements equal to an amount of at least 25 euros, which will be either in the form of funds or a professional liability insurance. Now, there are also some other obligations. Crowdfunding service providers must have in place effective and transparent procedures to receive and handle clients' complaints in a prompt, fair, and consistent manner. And this is also the case where platforms rely on a third party for the performance of certain operational functions. So every platform shall establish some procedures in order to receive complaints from investors and addressing those complaints in a prompt and consistent manner. From a market integrity perspective now, crowdfunding service providers are vulnerable to issues concerning the use of crowdfunding, as you already mentioned before, for money laundering, terrorist financing, and in general, illicit activities. So how does regulation deal with that? How does regulation deal with money laundering, for example? This is mainly addressed by obliging platforms to conduct a background check on the project owner before allowing them to offer a particular crowdfunding project through their platforms. And this background check is mainly conducted by obtaining evidence or their criminal record. So before allowing the project owners to offer investments through a crowdfunding platform, the platform should make sure that they do not have a criminal record. And at the same time, they must ensure that it is not established in a non-cooperative jurisdiction for tax purposes or in a high-risk third country with strategic deficiencies. So this aims to address the concerns about money laundering and crowdfunding being used for illicit activities. Now, again, with regard to platform requirements, we also have some market conduct obligations. And there is a general obligation for every crowdfunding platform to act honestly, fairly, and professionally in accordance with the best interests of their clients. This is an umbrella term which encompasses a range of more detailed conduct obligations that are owed to their clients. And these include, in particular, first, pre-contractual information obligations. So prior to entering a crowdfunding transaction, platform operators are required to provide their clients with fair, clear, and not misleading information about their business, the costs, financial risks, and charges related to crowdfunding services or investments, the criteria for the selection of crowdfunding projects, the nature and risks associated with the specific service provided, and also the financial products marketed on their platforms. At the same time, they should review the content and quality of information provided by project owners and, where appropriate, warn investors accordingly and suspend a crowdfunding offer until any omissions, mistakes, or inaccuracies are addressed. Finally, there are some market conduct obligations related to addressing conflicts of interest. So we said before that the simultaneous provision of crowdfunding services to both project owners and investors gives rise to doubts concerning the neutrality of crowdfunding platforms. So again, this background, the regulation requires that platform operators put in place and operate effective internal rules to prevent, identify, manage, and disclose conflicts of interest between themselves and their clients or between one client and another. More specifically, they shall not participate in any of the crowdfunding offers marketed through their platforms. Moreover, they cannot allow their major shareholders, managers, or employees, as well as any natural or legal person linked to them by way of control, to act as project owners and raise funds through such platforms. Finally, and for reasons of clarity, they must disclose to their current and potential clients the general nature and sources of conflicts of interests, and the steps taken to mitigate them. And such disclosures will be made in a prominent place of the platform's website and include sufficient details to enable clients to make an informed decision about the acceptance of the service in the context of which the conflict arises. So there's a question in the chat. I might keep that for the end of the presentation now, because time is passing. Let me go to the final set of provisions, which are mainly about investor protection and which are very, very important for you to understand. So, as we already mentioned, problems of information asymmetry and uncertainty are particularly acute in the crowdfunding context. And this is associated with three main factors. First, the relatively short track record of the businesses which seek funding through crowdfunding. So these are mainly small and medium-sized enterprises at the beginning of the funding escalator, which have not managed to establish themselves in the market. So there is not enough information about these companies. Now, the second reason is the retail nature of most clients, who therefore lack the necessary expertise to evaluate the risks associated with crowdfunding investments and the prospects of the project owner. So, contrary to professional investors, retail clients do not have the expertise and knowledge to assess the prospects of the project owner. And finally, the third reason is the fact that platforms do not provide investment advice. So they do not actually provide advice on whether investors should invest or not. So against this background, the regulation imposes detailed disclosure and notification obligations regarding both the crowdfunding services provided and each specific project, so as to allow an informed investment decision. So let's start from the disclosure requirements related to the crowdfunding services provided. In addition to the general pre-contractual disclosure obligations that we mentioned above, platform operators also have some specific information duties towards investors relating to the crowdfunding services provided. In particular, they shall warn prospective clients that their services are covered neither by a deposit guarantee or an investor compensation scheme. So they must inform their clients that there is a high probability that they will not take the money, the investments that they have made. So there is no scheme, there is no mechanism for protecting them from the risk of losing part or all of the money invested. In addition to that, they shall make non-sophisticated investors aware of the existence of the right to revoke their interest to invest and provide all information in a prominent place of the platform, which shall notify investors of their ability to revoke their offer within a specific time. Now, there are also some particular obligations in case that the services provided consist in the facilitation of grant of loans. So in these cases, platforms shall also disclose the default rates of all the loans offered through their platforms over at least the preceding 36 months. And why do they do that? They have to do that. Actually, they do that because this is a way for investors to know how probable it is to lose the money that they have invested. So if too many projects have defaulted, then they will have an indication of the risk associated with their investment. They should also disclose the key elements of the methodology for the pricing of crowdfunding offers and the calculation of credit scores, and also some key information on every individual portfolio that they manage. So these are the main disclosure obligations related to crowdfunding services. So what about crowdfunding offers? As we already mentioned, each crowdfunding offer shall be accompanied by a key investment information sheet, which is significantly less costly to produce compared to a full prospectus. However, we mentioned before that it is important that this way of reducing the cost of capital raising for businesses does not come at the expense of investors' need for comprehensible, meaningful, and accurate information. So how can we address this problem? How can we balance that less information for investors does not lead to less meaningful and accurate information? So how do we strike this balance between investor protection and improving access to crowdfunding for businesses? To overcome this problem, the regulation uses a very innovative way by utilizing the findings of empirical research in behavioral sciences, which provide abundant evidence that individuals suffer from cognitive limitations and biases, which often deter them from acting rationally based on excessive information. So while before it was believed that the more information the better, there are some findings now which suggest that it is not the amount of information that matters, but rather its content, quality, and format. And therefore, the regulation, in contrast to the paradigm of full disclosure, pays particular attention to the content, quality, and format of the key investment information sheet as a means for ensuring informed investment decisions. Now, let me go very brief to this content format and quality, and let me also spend 5 more minutes in explaining the Know Your Customer rules, and then I will give you the floor for some questions. Now, with regard to the content of the keys, it should be as complete and comprehensive as possible, avoiding information overload. It shall consist of a maximum of 6 pages of A4 sized paper if printed, and it should be accurate, comprehensible, and equally accessible for both local and foreign investors. Now, next to these disclosure rules, we said that we also have some Know Your Customer rules, and these apply specifically to non-sophisticated investors, because it is these investors that mainly suffer from cognitive limitations and biases. So what is the entry knowledge test? It is actually a test that crowdfunding platforms must do before accepting investments from non-sophisticated investors. And through this test, they can assess whether the services offered are appropriate for them. So in the case that such information is not provided, or where based on the information received, a crowdfunding platform concludes that a prospective non-sophisticated investor lacks the necessary knowledge and skills or experience for receiving the services, they shall issue a risk warning which would explicitly state the risk of losing the entirety of the money invested. And at the same time, investors should expressly acknowledge the risk they are taking before access to crowdfunding projects can be granted. So they run this entry knowledge test, they collect information about investors, they warn them in case that the crowdfunding platforms come to the conclusion that the services provided are not appropriate for them. And also, investors have to explicitly agree that they take a significant risk. Now, in addition to this entry knowledge test, crowdfunding platforms also require prospective investors to simulate their ability to bear loss. And this is an innovative and vivid way for counteracting optimism bias, as it helps investors project in the present the probable adverse future effects of inappropriate investment decisions. And the loss is calculated as 10% of their net worth based on their total and regular income and the frequency that this income is earned. However, this simulation shall not prevent investors from participating in crowdfunding projects. So even if it is assumed based on this simulation that more than 10% of the income will be invested, investors still have the possibility of participating in the market. Now, we also mentioned before about the pre-contractual reflection period. This is actually a period of 4 calendar days during which prospective non-sophisticated investors can revoke the offer to invest in a particular crowdfunding offer. And to do that, they do not have to give any reason and they do not incur any penalty. The role of crowdfunding service providers is particularly important in this context, since they have to inform investors about the existence and duration of this reflection period, as well as the modalities for the exercise of the revocation right. Equally important is the fact that they shall ensure that no money is collected for them or transferred to the project owner before this period has expired. And finally, and let me conclude with that, with regard to the protection of investors, given the high investment risks which are associated with crowdfunding projects, the regulation sets out certain safeguards which aim to prevent the overexposure of investors to them. So where the amount invested in an individual crowdfunding offer exceeds either the amount of €1,000 or 5% of an investor's net worth income, then the crowdfunding service provider shall refuse execution of the relevant offer unless such investor receives a risk warning, provides explicit consent about the investment, and proves that she understands the risks associated with the investment. So we have seen that the regulation puts into play different measures for, first of all, improving access to crowdfunding for businesses. Second, regulating the conditions for crowdfunding platforms to provide their services in the market. And third, ensuring a high level of investor protection. Unfortunately, I do not have time to go through the assessment of the EU crowdfunding regulation. These are 7 slides. You can have a look at the end of the presentation. You will be sent also an extended version of my presentation today, so you will have access to everything that has been mentioned in this course. To recap, we have covered the following issues. First, the financing constraints faced by SMEs, the role of crowdfunding in tackling these financing constraints. In this framework, we referred to the different crowdfunding business models. We then provided an overview of the benefits and drawbacks of financial return crowdfunding. Then we said why it is important to regulate crowdfunding, so how to balance between the different benefits and drawbacks. We also referred to the main objectives and challenges of the EU regulatory framework, while we also briefly discussed the main provisions of the EU crowdfunding regime. As I said before, you can have a look at the assessment of the EU crowdfunding regulation and potential provisions we can put in place in order to better improve the way that the regulation works. Now, we still have 10 more minutes to go, and I will dedicate this time in receiving your questions and providing answers to any issues that might have arising during this lecture. So the floor is yours now.
Okay, any question from the floor?
I've got a question. My question is, considering that peer-to-peer lending is a technology that is almost 2 decades old, and in spite of it having promises of disrupting the traditional financial sector, that is the banking system, unfortunately, it has never taken hold of the market. What could be the reason why P2P lending has struggled in comparison to other digital technology sectors which have successfully disrupted other markets?
Thank you for this question, even though your connection is not very good, but I think I managed to get the main idea behind the question. So if I understand well, the reason is, why does lending-based crowdfunding not developed so much as other forms of financing, which is actually not really true, I would say. Lending-based crowdfunding is quite a recent phenomenon, in the sense that it has been in place mainly and has been evolving during the last 10 to 12 years. And the market and the portion of the market that this funding tool occupies has been increasing throughout the years. So in general, the total volume of the crowdfunding market globally amounts to, if I'm not mistaken, to $1.5 trillion. And this is going to develop even further in the future. So I would not really agree with your conclusion. With regard to disruption, actually disrupting already existing traditional sources of financing is not always to the interest of investors and businesses. And this is why it is very important to have regulatory safeguards in place which can ensure that any kind of risks which are posed by these disruptive technologies can be adequately addressed. I hope this answers the question. I also can see a hand from Bima, so I would be glad to hear that question as well.
Okay, I just have a simple question. Like, I'm just curious on how the SMEs or the crowdfunding platform attract the investor to join to the crowdfunding, as SME has less credibility compared to like a bigger company. That's my question. Thank you.
Thank you. So the question is, how do they attract investors? Is that correct? Or
yes, sir.
Great. Actually, there are many different reasons. First of all, the use of the internet itself, so utilizing new technologies, is one of the most significant tools available for SMEs. So the fact that they can use the internet in order to attract investors from around the world is already a big development. But the attractiveness of a particular project really depends on many different factors. First of all, it is related to where this project is being promoted. So the use of the platform is very important. So the geographical reach of the platform used by SMEs is mainly the most important reason of success. At the same time, of course, it has to do with the pitch they prepared. So the more attractive the pitch, the more investors they will attract. And at the same time, it also has to do with the quality and prospects of the project. So they need to provide us more information as possible in order to allow investors to assess the prospects of the project for which funding is sought. And at the same time, it has to do with the quality of the project. Therefore, if they try to convince investors that their project is of a high quality, then they will have more opportunities of raising the capital required. Of course, it also has to do with promotion and advertisement, and this is why crowdfunding platforms also offer this kind of services, which allow the advertisement of different projects, both within the platform or also outside the platform. So it is a result of many and various reasons, factors, and yeah, but this is a very, very interesting question. I can see a question from Jovan. Jovan, I don't know how to spell it.
Yes, thank you, Mr. Konstantinos. If I may, I want to ask something regarding cryptocurrency, sir. So I think cryptocurrency is something that we know that basically there are no universal regulation for the cryptocurrency. My question is that sometimes cryptocurrency maybe can be used as a
Oh, I lost you. Sorry.
I'm sorry, I forgot to unmute, sir. Okay, I'm sorry, Mr. Konstantinos. If I may, I want to ask about regarding.
Yeah, I actually got that. So you said that sometimes cryptocurrencies can be used in the crowdfunding context.
Yes,
this
sir.
is where we lost you.
Oh, okay, sir. So my question.
Oh, okay.
Okay, okay. My question is that do you think in the future there will be a regulation for the major cryptocurrencies, sir? So, for example, one of the 10 biggest cryptocurrency like Bitcoin, Ethereum, like that. Do you think in terms of the European Union there will be some kind of regulation to provide some kind of regulatory something for that cryptocurrency? So I think that from in Indonesia, if we have a cryptocurrency and we make profit in a cryptocurrency, there are no tax in Indonesia, I think, sir, for that, because I already done that and I got no tax, for example, like that. Do you think in the future the cryptocurrency will have a regulation for that, and and cryptocurrency can be used as a crowdfunding, something like that? So I think it's important to know the future for the cryptocurrency regulation. I think that's my question, sir. Thank you, sir.
Thank you so much for this very topical question. I do not have a lot of time, so let me be very brief on that. When it comes to the offer of cryptocurrencies via crowdfunding, are you all familiar with that? So first of all, let me explain how this actually works. These are called initial coin offerings. So instead of offering securities or loans through crowdfunding, potential prospective project owners offer cryptocurrencies. So the way that a prospective investor participates in the funding of the company is through the purchase of cryptocurrencies, of digital coins. Now, there had been a suggestion during the negotiation of the European crowdfunding framework to include this kind of offerings in the current scope of the regulation. However, as I said before, passing legislation in the European Union is a result of many different factors and processes at different levels of government. Both the European Commission and the European Council disagreed with the proposal of the European Parliament to introduce initial coin offerings within the scope of crowdfunding regulation, and therefore, at least for the time being, this kind of offers are not included within the scope of regulation. Now, whether we're going to have a regulatory framework on cryptocurrencies, I do not know if we're going to have an overall, a general regulatory framework on how these currencies operate. But what we already have here in the EU is a quite advanced proposal for a European regulation which shall address the process for creating and offering cryptocurrencies through the market. So there has been a very big discussion during the last 2-3 years about financial technology and especially about cryptocurrencies. And I think that in the very near future, we will be able to have at least partly a regulation on the offer of cryptocurrencies.
Okay, thank
If
you.
you want further details on that, you can send me an email. It's in the last page of my presentation, and I can provide you with further information. I don't know if we have any more time for questions or we have to conclude here.
Any other question? One last perhaps? Okay, I think no more question. Thank you so much, Dr. Konstantinos. On behalf of IWEEK 2022, we would like to express our deepest gratitude for having you as one of our speakers.
I thank you for this beautiful opportunity. It's a great pleasure to talk about crowdfunding, especially outside the European Union context. I really hope that you found this lecture interesting and or at least stimulating to do some further research or study on that. It's been a great opportunity talking to you all. I really would hope to be able to be there maybe next year. But should you have any further questions, do not hesitate to contact me either via email or my LinkedIn profile. Thank you very much, and I hope all the best to everyone of you, and enjoy the rest of the International Week.
Thank you so much, Dr. Konstantinos. Thank you.